The American banking system is in a crisis. They've just gone and done the exact same mistake that they did in 2008. Because one thing we learn from history is we don't learn from history. But this crisis that is brewing right now is much bigger than what happened in 2008. And in today's video, I'm going to go over exactly how in the next crisis, there won't be bailouts by the taxpayers for the banking system. It'll actually be much worse. We're going to have bank bail-ins where banks can legally take your deposits and you can't do absolutely anything about it. That is, unless you listen to what I'm about to say in this video. Because the new crisis that's building underneath the surface is not subprime mortgages, it's actually the derivatives market. And for those of you who don't know what derivatives are, they're simply bets or massive leverage bets on financial markets. And Warren Buffett has coined these as financial weapons of mass destruction. And this leverage debt, these leverage bets have ballooned to over $220 trillion, almost 10 times the amount of US GDP and over 10 times the amount of US deposits in the banking system. And if you think regulators cleaned up all this mess after 2008, they didn't. The risks didn't disappear, it evolved. It grew even bigger, became more complex, and is now buried under layers of financialization designed specifically to hide its true catastrophic scale. We are talking about hundreds of trillions in interconnected bets built on top of debt and extreme leverage. So what could go wrong, right? Now, it's one thing to know that these markets are extremely dangerous and extremely highly leveraged, but we need to know what will be the fuse that will kick off the bank bail-ins. Well, it may have just been lit. Well, in the last month, we have seen the quiet collapse of several key companies. And this could be the tripwire that ignites the $220 trillion bomb. So the trigger for the next crisis, like in the last one, is always found in the everyday struggles of the American consumer. And right now, one essential item is hitting a breaking point, and that is the American's car. With 77% of Americans relying on a car to get to work, it's not a luxury, it's a necessity. Yet the average monthly car payment has soared to over $750. This is the third largest credit category in the country behind only mortgages and student loans. Now, the problem isn't the payment itself, it's who is getting the loans. Lenders like Primer Lender, Tricolor, and others who have recently gone under. They kept issuing loans to anyone and everyone, even those who clearly couldn't afford the payments, and this is the definition of subprime lending. Now, when a few of these subprime auto lenders collapse, it sends a tremor through the financial system. We saw this exact type of credit crack just before 2008 with the initial housing failures. Today, it's the car loan market. But this isn't the risk. This is just an early warning. The real risk comes next. Because these auto lenders knew these loans were risky. So what did they do? Well, guess what? Can you believe it? They did the exact same thing as they did to mortgages in 2008. They took thousands of these subprime auto loans, bundled them all together, and sold them off as a single financial product. This is a process called securitization. So they took all these subprime auto loans, mixed them together with these good loans, slice and dice them, mix it around, and then they sold it off to the US banks, private equity firms, and shadow lenders. So suddenly you have layers and layers of risk disguised as stability. But here's the kicker. They withstand with a AAA rating the highest level of safety. And this is why I'm now making this video. Because beneath that gold rating are borrowers defaulting at the highest level since 2009. So the risk is not in the single loan, it's not even in the company that issued the loan. The risk is on the exponential betting on top of one underlying failing asset. That is the definition of a derivative. A couple of loans go bad, and it's not just the loans that collapse, it's the tens of layers of financial bets piled on top of it. And this is exactly why Warren Buffett called them weapons of mass destruction. So again, this derivatives market is over $220 trillion when the US economy is $30 trillion. And the bad thing is this market is not slowing down, it's ballooning. Because from Q4 last year to Q2 this year, US banks added over $28 trillion of derivative exposure. Now, where was the regulator that was supposed to stop this in 2008? The 2010 Dodd-Frank Act was supposed to make this system safe. But what we got was watered down, ineffective rules that were often unenforced or even rolled back. The prime example was the failure of Silicon Valley Bank, which was exempted from stricter regulatory oversight just a few years before its collapse. But get this over $220 trillion of derivative only accounts for what we can see for US regulated banks. It completely ignores the world of shadow banking, the hedge funds, private equity firms, and money market funds that operate outside of transparency. The total true derivative risk in the market is more likely over $1 trillion, numbers we can't even get our head around. But the most critical difference between now and 2008 is not the size of the risk, it's who pays for it. In 2008, we saw tax-funded bailouts, and this led to a public outcry. And what this all led to was the Dodd-Frank Act, and it's completely changed the game of what happens when a bank fails. Instead of the taxpayer bailing out the banks or some kind of bank bailout, they created a new law where banks can legally bail in your money. This is a scenario where the bank facing failure can use its creditors' funds to absorb losses and recapitalize itself. And who are the bank's primarily unsecured creditors? The depositors. That is you. Under bail-in, your savings account, your checking account, your retirement depositors are legally at risk of being converted into bank equity, shares in a failing institution to keep the bank whole and save the system. And for those of you saying, wait, whoa, what about FDIC? My deposits are safe, right? Well, if only one small institution or a few small regional banks like what happened with Silicon Valley Bank go down, maybe yes. But here's the thing, the FDIC insurance only covers 1.3% of deposits in the US banking system. There's over $20 trillion of deposits in the banking system, and the FDIC doesn't simply have enough to cover all of this. And this is why the bank bail-in mechanism had to be introduced, because the FDIC and government simply cannot afford to bail out these banks because they've become so massive. Now, if you think this is a theoretical concept and it's very unlikely to happen, well, it's already happened multiple times in multiple countries. Because listen to this. In Cyprus in 2013, 2 of their major banks failed. What was the solution? Was a straight up deposit haircut. Anyone with over 100,000 euros in their bank account saw half of their deposits seized and converted into worthless bank equity. The savers were punished while the bank itself was kept afloat. But we've got another more recent example. In Lebanon in 2020, amid hyperinflation, the government immediately froze all customer accounts overnight. No ATM access, no withdrawals. For 2 years, citizens had no access to their cash. Eventually, half of their deposits were seized. So in both cases, the governments that printed too much money and the banks that had too much speculation, well, they were largely untouched, while those, the prudent savers, they were punished. So again, this isn't just a possibility, this is the legal foundation that's been laid under US law. And that's why we have to look at the warning signs. Defaults of the underlying assets of these derivatives are rising. This is very much a possibility, and you're at risk at footing the bill for the bank's poor decisions. And I believe a bank bail-in will go hand in hand with the next stage of currency devaluation. We're already seeing how much they're devaluing your money, and this will also go hand in hand if the US saw some kind of hyperinflation. But for those of you that are watching now, there is still time to protect your wealth. Most people aren't even aware that this is actually a law in the US, and not just in the US, but many major economies in Australia, in the UK, in Europe, etc. And so all these currencies that have experienced bank bail-ins, hyperinflation, what have all the smart people done? They protected their purchasing power with a real asset that cannot be devalued, it cannot be printed, it cannot be seized, it cannot be frozen, and that is gold and silver. And this is just another way you can diversify to protect your wealth. So everyone, for those that may have called you conspiracy theorists, said that this would never happen or this is just a conspiracy theory, you can show this video to them and tell them, no, this is actually law. But everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.